You see, if we reduce our interest rates and lower the exchange rate in the US dollar relative to Japan and their exports falter, they'll have to do the same. One of the arguments that gold has in its favor is it's the only form of money that I know of, perhaps crypto could join that, but I'm not sure, that doesn't have a domestic political constituency for devaluation. If the euro goes down, European exports are more competitive. If the pound goes down, British exports are more competitive. If the renminbi goes down, Chinese exports are more competitive, and so on and so forth. Gold is the only traditional expedient form of medium of exchange that doesn't have a political constituency for devaluation.
Gold is on an unbelievable tear, now resting above $3,900 per ounce, and the reason is simple. Most foreign governments and central banks around the world have traditionally held the overwhelming majority of their strategic financial reserves in US dollars. And that made sense. The US dollar has been the undisputed global reserve currency for over 80 years, backed by unshakable confidence in America's economic strength and governance. But that sentiment has changed rapidly over the past few years. Seasoned market strategist RickRule notes that central banks are doubling down on gold for two key reasons. He points out that Washington's use of the dollar and SWIFT as political weapons, like seizing $300 billion in Russian assets, has shattered trust in Treasuries. For months, the gold rally has been driven by smart money, central banks, and insiders. However, we are now seeing retail investors finally begin to pour into gold ETFs. It's the widening participation that signifies the bull market is broadening and gaining unstoppable momentum. Rick predicts that this trend will accelerate, citing the ultimate driver of gold prices in fiat currencies, especially the US dollar. By mid-September, in fact, the GLD Gold ETF saw a $2.2 billion inflow in a single day, the highest in its 21-year history. And those inflows translate into physical gold purchases. Gold could easily triple or quadruple over the next decade, mirroring the massive collapse of dollar purchasing power seen in the 1970s. However, investors must be prepared for extreme volatility. Even in past corrections of 50% or more have been common. With recent bond auctions showing pathetic participation, Rick warns the market is setting the stage for a forced sell-off. Before we dive into RickRule's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think central banks are absolutely going to continue buying at these levels for two reasons. One, the weaponization of the US dollar, the weaponization of the SWIFT banking system. Whether or not you agree with Russian foreign policy, the fact that the United States government stole $300 billion worth of Russian assets in the form of U.S. Treasury securities did not endear the United States to other countries that think that they may run afoul of Congress or our president. The trend away from U.S. dollar-denominated instruments, in particular U.S. Treasuries, and in favor of gold is a trend in motion. The BRICS have difficulty settling with each other in their own currencies because they don't want to own each other's currencies. But there's a mechanism in place now, in effect BRICS money, where countries can settle very briefly in their own country and then convert that currency to gold, which means that gold is, at least in terms of trade between countries outside the US and Western Europe, again becoming money. And I think that's important. The second thing is that the U.S. Treasury is arithmetically a bad deal. If you agree with me, where I suggest to you that the CPI is a lousy gauge of U.S. inflation, where in fact the true gauge of U.S. inflation is more like 7.5% or 8%, measuring the deterioration of the purchasing power of the U.S. dollar. A U.S. Treasury that's offering you 4.5 in a currency that's deteriorating at 8 is a lousy deal. It means you're losing 4.5% a year. And foreign governments aren't stupid. They've come to, recognize that to be true. The third thing that's happening, and this trend is only about 18 weeks old, is that you're beginning to see retail participation in the gold market, measured by funds flows into physical ETFs. It wasn't till about 4 months ago, despite the fact that we've been arguably in a gold bull market, really going all the way back to the year 2000, and a much more aggressive gold bull market in the last 2 years. It wasn't until between 15 and 18 weeks ago that we began to see a retail flow of funds into gold, measured by the physical ETFs. I think that's important for people to know. So if you ask, can this keep going? I would be a little stronger. I think it's probable that it will keep going. I think that, and I'm on record saying this, first of all, the most important determinant of the gold price is investors' favor or lack of favor in fiat currency denominated savings instruments, but particularly US dollar denominated savings instruments. And the arithmetic around that is not good. In the decade of the 1970s, the US dollar lost 75% of its purchasing power. I believe the next 10 years will be similar to that. If you believe that, it makes absolute sense that at least the nominal price of gold, the US dollar price of gold, will mirror the decline in purchasing power, which would suggest a threefold or fourfold increase in the gold price in the next 10 years. That's the good news for gold holders. That's the stuff that'll make all of your listeners with Jay Martin happy. The bad news is that even in a bull market as strong as the bull market that we enjoyed in the 1970s, where the gold price itself was up 30-fold, in the middle part of that decade, 1975, when the U.S. government fairly dramatically raised interest rates, the gold price fell by half. And the XAU fell, well, the predecessor to the XAU, fell by 65%, I'm sorry. The point of all this is that you can have a 10-year bull market where the price of an asset class increases threefold or fourfold and still conspire to lose money if you have one of these precipitous declines that shakes you out. So in real answer to the question, yes, you're on a train in motion, but it's not going to be a smooth ride because these rides never are. I don't think that there is a domestic political constituency for a stronger dollar. The president himself has said that he would like a lower dollar to encourage U.S. exports. And that's a real argument in favor of holding gold. You see, if we reduce our interest rates and lower the exchange rate in the U.S. dollar relative to Japan, and their exports falter, they'll have to do the same. One of the arguments that gold has in its favor is it's the only form of money that I know of, perhaps crypto could join that, but I'm not sure, that doesn't have a domestic political constituency for devaluation. If the euro goes down, European exports are more competitive. If the pound goes down, British exports are more competitive. If the renminbi goes down, Chinese exports are more competitive, and so on and so forth. Gold is the only traditional expedient form of medium of exchange that doesn't have a political constituency for devaluation, which is interesting. The second point, I guess, no, let's leave it at that. With regard to the direction of interest rates, what you're starting to see in the U.S. is divergence in the market, which is to say the Fed is actively buying the near end of the curve and actively jawboning down interest rates. So the Fed is controlling the Fed funds rate and even the 2-year rate fairly effectively. Despite that, the long rate is going up, which means that the market is beginning to take control of the 15, the 20, and the 30-year. Remember that unless the Fed buys its own paper, the long market is a market. And recently, they've given some long auctions where not very many people showed up, which meant that the interest rate has had to rise, or the nominal pricing of the bond has declined. So it would appear to me that the political forces are still in control of the near end of the yield curve, which is to say 90-day to 2-year, maybe 2.5-year. But the long end of the market is becoming the province of the market. And it's almost certain from my viewpoint that absent a major recession, that the long end of the market continues to have to offer higher yield, which is to say the bond pricing in the long end of the market has to fall.
Gold mining stocks have delivered a stellar rally, with some companies seeing gains of nearly 200% year to date. Yet, a leading macro strategist believes the sector remains significantly undervalued and is poised for historic profit margins. In the interview, RickRule suggests that an S&P gold shift could follow a Newmont-Barrick merger or Agnico-Eagle's rise, but cautions that most miners lack the cash flow that justifies tech valuations, Still, if gold continues to rise, the margins of top producers could surge, similar to the 1970s. On strategy, Rick explains he reallocates that capital into physical gold or major royalty and mining companies, reducing exposure to speculative juniors while keeping strong leverage to the sector. The real explosive potential, however, hits the junior silver stocks. These tiny, overlooked companies can see some of the most dramatic parabolic surges in the entire resource sector once that massive wave of generalist money finally reaches them. Silver is the fuse, and the juniors are the bomb. Let's get back to the interview.
What may happen is, and this is not inside information. This is just a supposition on my part. It may be that Newmont and Barrick merge now that Barrick's CEO has decided to depart and pursue other employment opportunities. If that happened, it isn't the same as adding another S&P name, but it would increase the relative importance of Newmont in the S&P 500. To the extent that Agnico Eagle continues to be as successful as it has been in generating free cash and hence market cap, that would be a logical addition. Again, though, you have a valuation issue. People have remarked frequently about the market capitalization of NVIDIA market cap and Apple relative to the market capitalization of the gold sector. And I don't mean to be a naysayer, but if you look at each of NVIDIA, Microsoft, and Apple, they generate substantial free cash. And the gold mining industry as a whole, if you take it all the way down to the penny mining stocks, is cash flow negative. So, of course, a company that's generating a lot of free cash flow would have a higher market cap than others. If, for reasons that you and I have discussed at length, the gold price continues to run, one would expect that the margins associated with the best gold mining companies will go on the same tear that they went on in the decade of the 1970s. And if that happens, then of course you're going to see fairly dramatic market cap advancement. That isn't a reason, though, not to sell some gold stocks, particularly some of the little ones that have enjoyed 400 or 500% gains in fairly short periods of time. I've got a lot of social media hate in the last week from saying that I was selling 30 or 20, 30, 40% of some of my holdings in the small companies. They're saying, listen, it's contradictory. You say the share prices are going up and you're selling some. It's all personal. The fact that I can sell 25 or 30% of my upside in return for eliminating my downside. And by the way, some of the capital that I'm raising selling these junior positions, I'm putting back into gold itself, or Franco itself, or Agnico itself, or Wheaton itself. I'm not cashing myself out of the beta part of my bet. What I'm doing is de-risking the alpha part of my bet. I believe that gold is a savings asset, an insurance asset, and silver is a speculative asset. The consequence of that is that I save in gold, but I speculate most in other materials, not silver. I do speculate in silver stocks, which I think represents silver on steroids. In my experience, precious metals bull markets are always led by gold. The first investor to the race is the fear buyer, and that's the gold buyer. Again, in my experience, when the precious metals narrative is established by momentum in the gold price by the fear buyer, the greed buyer steps in. When the generalist investor comes into the precious metals space, for whatever reason, I'm not sure why it is, he or she goes to silver, likely because it has lower unit cost. And when that happens, leadership and momentum goes from gold to silver. That may be what we're in the middle of experiencing right now. Silver increasing in price faster than gold, although both of them are going up. The most volatile asset class in precious metals, in fact, in resources that I know of, with perhaps the exception of the junior uranium stocks, are the high-quality junior silver stocks. The leadership needs to be established firmly in the silver commodity quote. But when the junior silvers start to run, at least in the three bull markets that I've been alive, that's truly a sight to behold. I think it's because the combined market cap of the reasonable quality juniors is so low that when the generalist investor comes into the space, the money that comes down into that silo is so large that the market caps won't hold it. At least that's been my experience. And by the way, it's been a very joyous experience being long the junior silvers in those circumstances.
In closing, RickRule emphasizes that gold's role is expanding beyond its traditional safe haven status. With central banks diversifying out of treasuries, retail investors now entering the market, and structural cracks appearing in the bond market, he believes gold is positioned for a potential revaluation that could redefine its place in global finance. Most of the long-term gold rate predictions were met ahead of schedule and remain bullish for the next 5 years. Projections for 2030 span a wide range from $4,800 to as high as $8,900, with most consensus targets clustered around $5,000 to $6,000 if current inflation and uncertainty trends persist. Are we simply in the midst of another gold bull run, or is this the start of a deeper structural reset in the global financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.